Hey, welcome traders. Welcome to this live webinar with FXDD. My name is Chris from Elite Currency, and this part is taking a look at how to understand market structure, part 2, intermediate level. Of course, there's always a gray zone, what is beginner, what is intermediate, but we're going to continue after we left off last time. If you wonder which webinar that was, it is uploaded to the FXDD YouTube channel. So we highly recommend you to subscribe to that as well. So you can check out more videos from Nennet and myself. All right, so let's get started with this webinar. Before we do that, we just a risk disclaimer explaining the fact that trading foreign exchange and the global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for informational and educational purposes only. All right. Now, I wanted to repeat the slide that we showed last time, and then we'll take a look at the live market, which is the fact that the market structure has patterns, trends, support or resistance. That is the triangle we looked at last time, and we were looking at all three items. And we gave some examples with regard to the patterns, what are patterns, what is trend, what is support or resistance, and stuff like that. So from this perspective, we covered kind of the basis as far as I remember. I was a little bit, still had a cold at that time, but if I remember correctly, we did discuss all of these three items. I want to dive in today a little bit about how to combine all of these things together. And then also want to dab into the next part, which is discussing how you can trade your analysis by using triggers, decision zones, and of course, the entry, logically speaking. So that's going to be, we're going to take a look at all of these things with live charts and looking at live/past charts, of course. And yeah, we're going to do that right now. Before we do that though, just a quick heads up. Not only the YouTube channel is handy, but for those that are live here, you already know it. But for those that are looking at the recording, perhaps on YouTube, you can check out these links to sign up to the live sessions of the webinars. The top link is for trading webinars, and the bottom link is for educational webinars. All right. So if you want to join live, just go to these links and check out the timing, the schedule of the webinars you are interested in. All right. Now you see me zoomed in, and we're going to move to the charts soon. There we go. Alrighty. So, things I wanted to talk about today is, generally speaking, we're looking at, when you're looking at the rhythm of the market, the heartbeat of the market, as I like to say, it is always a question, of course, of slow versus fast price movement. Slow price movement is corrective price action. Fast is impulsive or momentum. And of course, price can be bullish or bearish. So typically, there are 4 different patterns or 4 different types of basic price movement. We call it the DNA of the market in a way. Very simply said, it is bullish momentum, bullish correction, bearish momentum, or bearish correction. And if you can identify these patterns and estimate what the next pattern could be, you will have a heads up, because that will give you information about what the market is communicating to you. Right? This is a language. This is all basically like learning a foreign language. It takes a little bit of time at the beginning, just a few words, so you only understand a couple of things. But as you add more words, more vocabulary, you will understand and communicate more fluently in that language. Well, in my view, analyzing the charts is nothing different. And of course, we can never, we shouldn't aim for being perfect in our analysis. There's nothing, it's just impossible. The market is too yeah, it's too volatile. You cannot. It's not about being right 100% of the time. It's about finding the setups where you have a long-term advantage and avoiding the ones where you don't have a long-term advantage. And if you follow your strategy day in, day out, and you have 40, 50 setups, then you can analyze whether that long-term approach is working or not. So anyhow, back to what we were talking about. So this will help you analyze and understand the communication of the market. And it is, it just gives you a lot of info about what to expect. The swings themselves, right? The price swings that you see here are either momentum correction or bullish or bearish. And if you know if price is moving fast, if it's an ongoing momentum, or if it's a finished swing, price swing, that gives you a lot of info. It gives you a lot of information. So for instance, here we had the start of a swing. Here we had the end of the swing. That's one swing. That was basically a bearish momentum. And it had 5 waves for those that like wave analysis. 1, 2, 3, 4, 5. And then we started the bullish swing, as you can see. So knowing that this bearish swing is over and a new bullish swing might start is useful information. Now, this is too soon. You might wonder, oh, how do I know that? This is all things we're going to be discussing in this webinar. For now, it's just important to understand what is that. So let's take a look a bit at these charts, and you can see that, for instance, here we had a lot of range in this area right here. So that was choppy price action. Here, this was bullish momentum. This was bearish momentum, right? Overall, let's take a look. Here we have another choppy price piece. This is a range. This is a correction, right? So let's move on. Are there any questions? No. Good. So all right. So these swings basically are like a building block of the market, of the chart, right? The candlestick is the smallest unit. Then you have multiple candles that could make a candlestick pattern. And a bunch of candles make up a swing, a price swing. Multiple price swings make up a trend or a range. And the trend or range could make chart patterns, price patterns, wave patterns, right? These swings make wave patterns. And when you look at trend and range, you're looking at the bigger market structure in general, right? So let's take a look at some of this momentum. How do you recognize that price is in a momentum? So it's important to know that when you have momentum, that the majority of the candles are bearish or bullish. So if you look at this part right here, right? Why was this momentum? Well, if you analyze it, you see clearly bearish candles, right? That's most of them are bearish. You have a few bullish ones, but you're looking at about 70% bearishness. The bearish candles are sizable. They're bigger, than the bullish candles. So the bears are in control, and the closes are near the low, right? Most of these candle closes, the bearish candles at least, have a close near the low. All of that indicates that the bears have the power at this moment. They are controlling this price action. This is momentum. Okay, is that clear? Correction is where you have basically a mixture of candles. Oh yeah, one more thing with momentum is that the opposite candles are, smaller typically. So the bullish candles here are, not all of them, but many of them are small. When there's a correction taking place, there's more indecision. All right, let's try to find the example. Here's a small one. I'm looking for a little bit bigger zone. All right, here in this piece maybe, right? Right here. Somewhere here in this part. So you see that the moving averages are like hitting each other, those short and the long-term moving averages. You see that, if you look at this piece, it's about 50-50. Half of them are bearish, half of them are bullish candles. In some cases, you might have smaller candles. Now, in this case, it's not really so. You have pretty big candles. There is actually momentum parts in this sideways price action, there's actually momentum. That's why the candles are not too small, but it is a range. It's just that price was moving pretty quickly within that range. You sometimes have ranges that are, very, very flat, like here, this piece, for instance. Two parts here, this piece and this piece. That's, a very corrective correction. This was more of an impulsive correction, right? It was faster. Here you see price action is really slow. It's just very small candles, a mixture of candles. The closes are not near the high or low. They're like dojis. Not all of them are dojis, but you have plenty of like smallish kind of candles like this. Here, look at these small candles, 3, 4 in a row. All these are small candles. They really have no body at all. You're literally looking like at a candle of 12 pips, which for a 4-hour chart is small. So that's momentum and correction. And by the way, I know that not everyone is a big fan of Elliot wave theory, but all that wave theory does is analyze each swing and say, okay, that's a bearish momentum. That's a bearish, bullish correction, So it analyzes all of these swings and tries to understand their nature of the swing. And then based on the sequence of swings, tries to estimate what is the next swing. So it's like building a story, interpreting a story, and understanding what is the next chapter of that story. That's what wave analysis is all about. Now, of course, it's not that simple, but basically this is the heart of the matter. And they analyze the story by labeling the swings, the price swings, with numbers and letters to understand the story and the sequence of that story. All right. Anyhow, I don't want to dive into wave analysis, but I'm just giving you an idea about the importance of swings for wave analysis and for Fibonacci. So if you like fibs, this is important. So now that you have an idea of, okay, what is momentum and correction? Now let's talk a little bit about how do you recognize the momentum and correction live, actually right there, right then. And that's, of course, something that's more difficult. It's sometimes easier to see it in retrospect, obviously. But I do have a couple of rules. I'll tell you one for the moment. Momentum starts when one of the rules I use is if you have 3 candles in a row. Okay? So if you have 3 candles in a row that are bearish or bullish, that often indicates momentum. Now, that doesn't guarantee anything necessarily, all right? But it's just something of a warning sign that's where momentum can start. Here are 3 candles in a row, and indeed bearish momentum starts, all right? Here are 3 bearish candles in a row, but really it didn't go anywhere. So context is important. I'm not saying that every 3 candles in a row is something you want to trade or so immediately. I'm just saying that it could indicate a momentum. Here, 3 in a row, it's counter trend, but it indicates momentum to the upside. All right. So it's a clue where the momentum could start. A different clue, and I'm not 3 candles, by the way, not only 3 candles in a row, but 3 decently sized candles is better out of a group of 6 candles. That already is enough. Is already quite a significant sign. Another rule I use is time pattern. So, for instance, you see if momentum is taking place, this is downside momentum. You see that, right? And another, by the way, with regard to momentum, I forgot to mention that not only do you have a majority of the candles down, but you have regularly new candles pushing for a low. So this is actually a good maybe a good moment to talk about time pattern, because if you have 5 to 6 candles not confirming a low or high, that is another kind of factor or clue that momentum is ending and correction could be starting. Look at this downside. Not only do you have most of the candles are bearish, not only do you have most of the candles close near the low, Most of the candles are pretty. The bearish candles have some, a decent amount are sizable, but most of these candles do confirm a lower low. Not all of them. Here, there are a few candles that don't have a lower low. Here's one. Here's one. Here are a few. So, not all of them. A lot of them confirm a lower low. But my rule is that if 5 to 6 candles don't confirm that low, then a correction, bullish or bearish correction could be starting. Okay. Now, what type of correction, or maybe even reversal, that we don't know. It depends. That depends on other factors. But 5 to 6 is generally a good idea. So yeah, here for instance, 2, 4, 5, 6 candle, not breaking this low, and indeed we got a bigger retracement. That's the idea basically. Okay. That helps identify when momentum starts or ends. All right. So now these corrections, these corrective patterns make chart patterns basically. Bull flags, bear flags, head and shoulders, or inverted head and shoulders, double top, triple top, double bottom, triple bottom, rising wedge, falling wedge. These are all formations. These are price swings that when you look at them together, they make patterns, and that gives us information about the psychology of the market. Those patterns can fail or be confirmed. When price is breaking through a bear flag, right? And it is a good breakout, well, that's a confirmation of that pattern. If there's a false breakout, that's like an invalidation of that pattern. That can happen. The markets repeat, generally speaking, but each situation is unique. Each particular spot in time and price, is unique, although things are very similar to the past. So that's why nothing can be 100%. But by using corrective patterns, you have a good indication. And by using candlestick patterns to understand if price is breaking through those patterns, you can get good confirmation. So let's take a look at an example. Sorry about that. Let's get rid of these lines. So here we had a bit of a steep correction. It's like it's an ABC zigzag correction. A zigzag here, as you can see, 3-wave zigzag. Moving averages are aligned to the downside. All right. So this is a corrective pattern as well. So when is that corrective pattern? When is that confirmed that this is a corrective pattern? When is price going to basically confirm that these swings are over, right? This breakout candle right here, pushing through the support trend line, is an example where you get a confirmation of via a candlestick pattern. Corrective pattern is probably over because the moving averages are aligned to the downside. Short-term moving average is below the 144 EMA, 21 below the 144. Price is below the 21. So you're in a downtrend. Okay. And the confirmation that this correction is over is this candle. So the candlestick pattern helps confirm the end of this corrective pattern, chart pattern. But always keep in mind that nothing is perfect. The market, the market is the market. It will do what it wants to do. We can do our best to analyze it as good as we can. But, it doesn't mean that the market will necessarily make a copy of exactly of what our analysis is. We got to be ready for changes. We got to be ready for interpreting new information from the market and trying to assess if our analysis is still spot on, is still correct, or if the market is giving clues that something else might be going on. Okay. So, that's very important. Now, to keep in mind, let's switch gears here. Let me think. Maybe it's a good moment to talk a little bit about bias, because the thing is that all these patterns create bias in a way, right? Or analysis in general creates a bias. Even if you don't think you're analyzing, even if you are trading only a strategy, still the strategy is giving you a bias, because you know, bias is a direction. You need a bias if you're trading. When you want to have a, you need to, if you want to enter the market, you want to go long or short. Why do you go long or short? There should be a reason, right? If you have a strategy and a trading plan, but that trading plan does create a bias, and that's good, you know, but you just got to make sure that the bias is based on experience, on a clear plan, on, you know, what we use, Ned and I, is technical analysis. I add a bit of wave analysis to it, but it's clearly all based on charts. That's, you know, the reasons for us to trade it. And the whole idea is that we basically read the chart and the structure of the market, what I'm now explaining you, the market structure, to find trades that give us a long-term edge. We are aware of the bias. We know that, you know, analysis creates a reason for us to trade it, and that's good, because if you don't have a reason to trade, you might self-doubt some trades. You might be wondering, you know, you might be thinking, okay, you just entered and then you already doubt your trade setup. You know, that's not good, of course. When you have a reason to trade, that's important, and you follow on that reason. But it doesn't mean that you totally neglect what's going on after that. Some traders hang on and cling to their bias, and when the market gives them information, new information, they ignore that because they think, no, I must be right. The thing is that the market will do what it wants. So we have to be responsive and alert to what it's communicating. So although the analysis could have looked like it's going into direction A, but if new information comes along and says, no, it looks more like B, it doesn't make sense for us as traders to put our hand in the head in the sand and ignore those clues. At that point, it looked good for A, but new information saying B. Let's use that and be wise and you know, try to understand that the market is indicating that whatever we thought in the past is not that valid anymore, right? So bias is good because it gives us the necessary stamina to stay in a trade, but we don't want to over attach ourselves to that trade and misread patterns that are emerging. We want to be flexible and open-minded to the new information, and if it's needed at the appropriate time, which is more of a trade management issue, you know, that we don't have time for that. We can have a different webinar on that. Then yes, then you can adjust your plan or make decisions based on that, and you don't want to just stick to one direction regardless. So yes, vision is needed, bias is important, believe in your trade, but remove the attachment and, you know, look at it with neutral eyes, basically. Okay, take in the new info, but adjust your analysis, but slowly, right, at the appropriate times, basically. Okay, and of course, trading plans, strategies, backtesting, evaluating, all of that is important to be on guard, be prepared for managing that bias in a way. All right. Now, thank you. Well, I have to pause here because you know, I know that the YouTube viewers are not sure why, but I have to thank everyone for the congratulations there. I really appreciate that. And no, this is the first one for us. So first baby boy. So very exciting. And we are, you know, very proud and very happy. very happy that, you know, everything has gone well. And yeah, it's really a great moment. So thank you all for those great comments. And so yeah, I wanted to transition now to the next step. So, no, maybe I'm going too soon. Maybe I should talk a little bit more about combining. I'm not sure if I did that last time. Unfortunately, it was a while ago. I was looking at the previous webinar, but I didn't have time to check it entirely. But basically, when you're looking at the market, let's get rid of all the lines here. Let's see. Okay, so looking at patterns, looking at support resistance, looking at trend range, momentum correction, all of that, we can use to understand the market better. We can use different time frames too. So for instance, you can choose this as you like, but a good idea could be, for instance, to look at the daily chart, look what kind of support resistance is there, right? So on the euro dollar specifically, we had a 112.50, 112.75 support zone. It was one of the reasons why I was, cautious about this downside. All right. So support resistance is a good thing for the daily chart. You can always look at patterns. Of course, you can always look at patterns. So you see a potential three-wave here. That's something to note, that could be a three-wave pattern. If it is a three-wave corrective pattern, that means that upside could be possible, right? Whereas if it breaks maybe below this support level, then maybe that continuation of that swing, this bearish swing, is possible. Let's take a look at this bearish swing, right? Because these are bearish swings. You see it, right? You see clear momentum candles, bearish ones, close near low, majority are bearish, pretty strong candles. So at this moment, price is making a bearish momentum. However, it's approaching that support zone. So these are two conflicting kind of messages. What does the trend say? Well, there is no trend. Price is really ranging at this moment. So what kind of info do we have? We have, once again, price is not a trend. It's in a range. There is momentum to the downside, though. Price is approaching support, however. And the pattern, it looks like it could be a zigzag pattern, a corrective pattern, if that support zone holds. So all of that, maybe that's quite a lot for the daily chart, but you could do that on the daily chart if you see that. More importantly, support and resistance, I think, is key on the daily chart. 4-hour chart, you can look at trend, I think is good. You could look at patterns in general as well. And on the hourly chart, for instance, if you can use 2 to 3 time frames, depends on you. You could look at the 1-hour chart for potential breakouts using support or resistance. So not using support or resistance as a filter, not avoiding trades, because I would avoid shorting if it approaches this support zone for the first time at least. So that would be avoiding a trade. Whereas on the 1-hour chart, if price is breaking through a support level, you can use it to trade it. 1-hour chart, you can use for momentum. Very good to understand momentum and catch a momentum early and understand when the momentum is finished early. So those are a couple of ideas there, how to combine time frames. On a 4-hour chart, all right, we saw we did live. I remember we saw a falling wedge eventually. Of course, not right away. Let's see. Here, for instance, it didn't necessarily emerge yet. Maybe a little bit, but it was not that clear necessarily at that point. But later, after this bounce here, it became more and more likely that this was a pattern. So a reversal pattern. So the 4-hour pattern confirms is making the zigzag corrective pattern on a bigger time frame. This one here more likely. We have big support. We have no trend. It's a range. So all of these things are kind of adding up to say, okay, trading to the downside might be a little bit risky from a discretionary point at least, and trading to the upside is starting to become a little bit maybe more viable, more interesting. It is of course, trading to the upside is a reversal. Anywhere here still, even here actually, technically, because moving averages are not aligned. So that's how you can combine all of these factors to make a judgment. Now, whether you trade based on this or whether you use a trading system of your own, I mean, that's up to you. You could have your own trading system, but still use these concepts to to decide whether you trade those setups from that system. Maybe you analyze and you say, there is a signal based on my strategy, but I don't like it too much because of what, because of support, because of momentum, because of these and these, a couple of things. Whatever you pick up from this webinar, right, you can apply that to improving your own decisions on the triggers you get. Okay. So this is how you can piece it together. I know it was very quick, so I hope that's clear, but you can ask follow-up questions if you want. Basically, once you've done your analysis, you're going to get to a point where you either like the chart or you don't. If you don't, it's very simple. You don't trade it. That's the benefit of us retail traders, is that we don't have to be in the market all the time. We can wait for the points that give us an advantage in the long term, so that we only enter the market where we have a heads up, an edge. Heads up, wrong word. I mean edge advantage. And but if you don't like the chart, if you don't like what you're analyzing, if you don't want to trade a reversal, or if you think that the trend continuation setup that you see is risky, you just simply set it aside. You can maybe recheck it again soon, or you can skip it for the rest of the week, or the rest of the day, or the rest of the year. I mean, I haven't traded euro pound in ages. I'm not a big fan of that currency pair. So, you can make that judgment. If you like it, of course, then it's time to talk about trading. And how do you trade that particular analysis from a discretionary point of view? Maybe you have your strategy, as I said. Maybe you have a specific trading plan already. But if you want to trade your analysis discretionary, in a discretionary way, then this is the part I'm going to talk about now. So if you like the chart, if you like that time frame, because sometimes you might have a currency pair that looks awfully difficult on a daily chart, but looks wonderful on the hourly chart. So find the time frame and instrument that you think is interesting to trade, and that's the one you can focus on. You can try to catch that trade. So what do I look at? I look at decision zones. So that does. How many of you are aware of what decision zones could be? You think that does that concept make sense to you? So decision zones are basically, for those that are looking at the video, are areas where price is going to have to make a clear kind of decision. It's forced to reveal its hand, basically. So either price is going to make a bounce or break at that spot. Now, technically speaking, it has to make some movement at every point. This price is going to make up or down, I guess, or go sideways, right? But you want to focus on the points where you think that there is a bigger edge for you as a trader. So what I mean with that is that, let's say, trading it somewhere in the middle here doesn't give you much advantage. It's not a clear decision zone. Price is just oscillating around here. It's not very very beneficial. But let's take a look at this example right here. So we have clear momentum to the downside, and we have in a way a downtrend because the 21 is below the 144 EMA. And so what is a decision zone? If you have momentum like this, price below the 21 below the 144, and then price retraces back to the 144, the 144 EMA could be a decision zone in that case. If price bounces here, it could continue with the downtrend. If it finds its strength enough to break above it, pull back and bounce, it's going to reverse. Excuse me. So this 144 EMA is a decision zone. Price is going to have to indicate what it wants to do right there at that spot, right? And so basically, it's kind of like where we expect a bigger reaction, a bigger move. Here, when price breaks above the 21 EMA, right? That's could also be a decision zone, but yeah, you want to find the spots where there's a high likelihood of a reaction and a substantial reaction. So if price is, let's say halfway a range or overextended, those are more kind of risky spots. Range, you could see price going sideways, and if it's overextended, there's a chance of a reversal, but the reversal could be slow. So this 112.50, 112.70 area, that was a decision zone too. Maybe remember recently how we were analyzing this how I was analyzing in the sense that I was saying it's a decision zone. Price is going to either bounce or break. We need a clear, for breakout, it would be best to have a clear daily candle below it. And for a bounce, it would be good to see maybe price break above the 21 EMA, or have some daily candles here like this wick, for instance, this bullish candle. All of that is confirming that price is not able to break through that support zone. So this particular zone is strong. It's really, really key. Trading it here, maybe, right, is risky. Very close to the support zone, but price action is bearish. So dangerous to trade it to the upside because price action is bearish and price hasn't reached the support zone as yet. So maybe there's a small space to the downside somewhere here on a lower time frame. Maybe an hourly chart, you can sneak in 50 pips. But obviously, it is not really a key decision zone here, as much as the 112.50 round level. The more confluence you have of patterns, support, trend, momentum, the more confluence there is, the more key the decision zone is. So if you analyze the chart and you like what you see and you want to trade that instrument and time frame, the next step is to decide the decision zone. Where do you want to trade it? And that could be multiple spots sometimes, maybe one spot. But what is the decision zone? Is price there or not? If not, we need to wait for price to get there. And once it gets there, how do we trade it? All right. And that is where the trigger comes along and the entry. I got a question from Howie. Let me address that first. When you draw trend lines, do you use the candle body and the wick or the wick? Doesn't matter. And I definitely think it matters. Trend lines, if you have price closing below it, that it also, and the candle gives a lot of info about that. The candle gives good info whether it's a good break or not, or whether there's a false break, or whether there's a bounce. And that's just very useful info indeed. Let's take a look at the hourly chart. Now, be fantastic, and not all bounces are going to be fantastic. But generally speaking, I think it gives a heads up. I think it's an advantage. Let's take a look at, for instance, a break of these moving out. I know it's not the trend line, as you indicated, but look at this. These engulfing twins here. Breaking below the 21 EMA, right? That's a good breakout candle. Let's see if we can find a trend line. So this reversal candle here, breaking above the resistance trend line. Well, that's a good breakout candle. How's it continued? So the close is near the low. Sorry, the close is near the high. Pretty strong candle, big candle, volatile candle, clearly pushing above this trend line. Let's take a look at an example where we have maybe a false break. I don't know, maybe here, like this is a wick, right? Wick above. Well, that's not a good breakout, right? So if you're looking for longs, you would skip that. If you're looking for a short, you might think about a small trade. It didn't go too far though, but so candlesticks definitely matter and are very useful. So that is decision zones. So that could be a little bit tricky maybe, but all of that put together, if you like the chart, you would look for that. Where do you want to, you don't want to chase price or chase price too early or too late. Now, once you have the decision zone, so let's say let's use a hypothetical example here. Perhaps I think we have to do at the moment. We can look at a different pair maybe, but let's go to the pound dollar otherwise. Okay. So pound dollar, I had two fibs, I think. This one and this one. All right. So there were a couple of levels that were interesting, right? These fibs were interesting, were decision zones. Because if this was a wave 1, 2, 3, 4, a wave 4, we would expect price to bounce at these fibs. So that was a decision zone based on impulse to the upside, based on wave patterns, wave 1, 2, 3, based on this bullish breakout, based on the fact that here was momentum on a higher time frame followed by correction. So we would expect momentum to the upside. Let's see what else. We have price moving into the 21 EMA, and price before that moved away from it. So it moved away from it with a lot of speed, and a lot of momentum, and a lot of impulse. And when it hooked back to it, when it moves away from the 21 EMA with that much power, the 21 EMA often becomes support. Another factor. Now, that I'm not saying that analyzing this way, could trading based on this analysis is more difficult. Okay, but one of my main points is that you can still use this type of analysis, even if you don't necessarily trade with it, because you can trade based on the strategy strategies that you're using, whatever that is. But you can always use these thoughts to analyze and understand the market structure better, and understand whether your strategy will have interesting setups or not. So, for instance, let's say hypothetically, you get a short signal based on this candle. Your strategy does. Well, when you are able to analyze like this, let's give a positive example. You might say, no, I'm not trading this to the downside. It's running right into fibs. It might be a wave 4. I'm going to skip that signal. And if you did, that would have been a beneficial filter, would have been a beneficial reason. By skipping it, obviously you miss a loss. Normally speaking, the stop loss would be above here, maybe above here. It could still be alive, I guess, the trade, but it's not looking that great. So, and that said, if you're looking for indeed the bounce, this candlestick pattern right here could confirm the bounce in the zone, in the support decision zone that you're waiting for. So the decision zone are these fibs, and the trigger could be this candle, this bullish candle, this bullish reaction could be a trigger. You don't have to use a trigger, by the way. You can have a pending order right at the fib, right here at 129.86. Put the stop loss at, 129.45, and just trade it like that. All right. But in that case, the trigger are these fibs. They're also right over the entry. But you can split it too. You can say this is the decision zone this is the trigger. This is the trigger. And that could be entry, but it doesn't have to be. You can say, okay, this is the trigger, but the entry is when it breaks above the candle high. That's my entry at 130.06. So decision zone, these fibs. Trigger, this candle. Entry, the break of the high. You can play around with these concepts as much as you want, because you can also use a different time frame. You can say decision zone trigger, good, but the entry, I'm zooming into the 15-minute chart, and I'm taking a break of the candle high, but I'm taking the close above the 21 EMA. Or I'm waiting for 5 to 6 candles, not breaking below this low. 1, 2, 3, 4, 5, 6. All right. Or I'm waiting for you see price move up. I'm waiting for a pullback into this zone again. Well, you could have thought that, but you wouldn't have gotten the trade. So in that case, you would have missed the trade because there was no pullback. It flew up immediately, right? But you might have thought that, though, and it would not have been a strange idea to think about that necessarily, but it would not have worked out here. You could have waited for the break of a fractal, but you never got it. Well, you had this fractal, but you never had a fractal here until you had a kind of correction here. So you might have taken it maybe later. So not all of ideas are equally, you will not get always the entry you might dream of. Sometimes you will. If you're looking for momentum, 3 bullish candles in a row, this one or this one, for instance. So, you can combine these concepts. Now, I know there are a lot of combinations that might be confusing, but ultimately, it gives you a lot of flexibility. You can focus on the ideas that from this webinar you like the most. Practice with it, of course. Always practice on the demo first, so you understand what your approach better, and you understand your methods of analyzing and trading it better. But generally speaking, you can always, whatever indicators you use, whether it's mine or your own, you can use this sequence, which is decision zones, triggers, and then entries. Okay? Good. Well, I guess that's going to be it for today. I hope this helps. And, if you love all of this, use it all and practice with it. If you say, well, maybe not everything was that equally handy for me, but I like the momentum part, or I liked the triangle analysis part, pick the things that you think are useful to make your trading better. Basically, it's about 2 triangles. Once again, the first triangle is triangle of analysis based on patterns, based on trend and support and resistance. And the second triangle is based on trading that analysis, if you like the chart, of course. And that is based on decision zones, triggers, and entries. All right. So good. I'm sure everyone's a little bit tired now after a 45-minute, good discussion here. What pairs I don't trade? Well, I don't like Europe. I mean, I have traded in the past, but I'm at a point that I'm really not that interested in it. I'm not saying I would never trade it. If there's maybe some nice long-term swing potential, yeah, maybe. Again, I'm just not a big fan of the Europound myself. So a little bit slow, not not my favorite. I'm not Europound is probably my least favorite. I'm not a big fan of the dollar cat either, to be honest, but I still analyze that one and trade it here and there. What else? Yeah, when I look at the markets, it's mostly the majors and major crosses, and sometimes a minor cross. Okay. Well, folks. Cool. That's great news, Howie. Yeah, I think there was one indeed recently, wasn't there? Dollar cat trade on the Telegram channel, indeed. Great stuff. We'll have to see, of course. Time will tell, indeed. We're going to be back with one more market structure one. It's the advanced session. I'm going to tie it all together. And that's going to be, I believe, tomorrow evening. Now you're wondering why so quick, back to back, but that has to do with the baby, indeed, because the baby is going to be coming back, or not back, here to my place, and yeah, just easier to have the webinar earlier. So that's going to be tomorrow. In any case, if you're looking at this on the YouTube, it should be uploaded. That webinar should be uploaded soon, by the end of February, beginning March, and you can see it on the YouTube channel. So this is part 2, and there's a part 3 coming. So if you're curious about that, check out the YouTube channel from FXDD. Wish you all great trading. Once again, more FXDD webinars and videos you can find on the FXDD YouTube channel and through the Crowdcast links. And we'll see you all very soon. Cheers.